Hello and welcome to this special edition, Markets 2022. I'm Prashant Nair. Stock markets around the world are witnessing capital outflows as central banks hike lending rates on the back of skyrocketing food and crude oil prices. How should investors prepare to survive and maybe later thrive amidst this turmoil? And how are markets expected to trade? We are now joined by someone who has a top-notch worldview about these matters. Chris Wood is Global Head of Equities at Jefferies, and he's joining us right now on the program. Chris, it's always a pleasure having you with us here on CNBC-TV18. Prashant this side. Markets in turmoil, I think, aptly describes the situation we find ourselves in. Last time we spoke, which was around a month ago, you had indicated that things are likely to remain tough. Have they gotten tougher, especially after what the European Central Bank on Thursday did, sounding a little more aggressive as compared to what the market was expecting? So it's not just the Fed now, it's the European Central Bank as well.
Right. Well, things have not really changed too much since a month ago, in the sense that the major central banks of the world have done massive U-turns since late last year, i.e. the Fed and the ECB, and they've now embarked on monetary tightening cycles. In the case of the US, the big news this year, but the most important news on monetary policy this year happened at the very start of the year when the Fed brought balance sheet contraction up the agenda in terms of time. So we now are about to commence a double whammy of monetary tightening, higher rates, Fed balance sheet contraction. So long as this agenda is being pursued, it's bearish for the US stock market, and I would be astonished if the S&P doesn't correct by at least 30% from its peak, so long as this agenda is pursued. The big question for this year is, does at any point the Fed language change, i.e. to a softer stance? And I believe that becomes a greater possibility, if not a probability, later in the year. But for now, the Fed's standing hawkish. And as I think I said a month ago, key point to understand is there's political pressure from Washington for the Fed to be seen doing something about inflation, because all the opinion polls show that inflation, rising prices, is a #1 issue concerning Americans. As for the Eurozone, they've done an equally spectacular U-turn, the ECB. But in the case of the ECB, there's actually a silver lining to higher rates, in my view, because it will liberate the Eurozone banks from the lunatic policy of negative rates. Since I view negative rates as a negative for an economy and the banking system, actually, perversely, higher rates are a positive in the Eurozone.
Chris, you said at least 30% fall on the S&P. Could it be significantly more as well from the peak? So we're down about, what, 20 right now?
Yeah, but when we go past 30%, then I believe the market, the market will be very sensitive to any sign of the Fed backing off. The other issue, but how we get an overshoot over 30%, is in a situation where Fed is continuing to tighten, and let's say come next quarter, we've had 2 consecutive quarters of down markets in the US. Then when the investors get their statements, the retail investors, then I think there's a greater chance that we get significant outflows out of these ETFs. So because a very big difference between the US stock market and the Indian stock market is you've had in the last 10 years or more in the US huge flows into these ETFs. Many of these ETFs are linked to indices, most particularly the S&P. At the start of this year, there was more than $1 trillion US linked to S&P index ETFs, which means all this money owns the same stocks. And if you start to get major outflows out of that kind of product, then that's how you get an overshoot on the downside.
And that's how you get an overshoot on the downside. Chris, in your opinion, is the economy already starting to slow in the US? For example, earlier this week, there was the story which was talking about how freight rates for shipping into the US has collapsed. And shipping stocks all sold off, not just in the US, but in Europe, etc. as well. Maersk, for example, other shipping liners, all cracked. People extrapolated that to mean that, growth is already starting to come off sharply. There are other indicators as well, but at the margin. Your sense?
No, clearly at the margin, growth will be slowing. We've seen that, I think we see that already in the interest rates, the classic interest rate sensitive sectors in the US, like autos and housing. That's why some of these cyclical sectors will now become vulnerable, where the growth stocks have already been hit. But I'm not an economist, though, and at the end of the day, a recession is just a technical definition. But the further you go forward in time, the more likely the US is to enter a recession. So I would be surprised if there's not material evidence in terms of the data of a slowdown in the US economy come the fourth quarter of this calendar year. But probably the most bearish looking signal we have right now has been a very significant decline in US consumer confidence, more than I would have thought, actually, given there's still high nominal wage gains in America. But US consumer confidence has weakened dramatically, and you wonder if that's linked not only to rising prices, but people being hit by the stock market. The other recent development has been a plunge in the US household savings rate, which I believe is now back to levels from memory of 2012. So these cash buffers the US households built up as a result of partly because of the relief, the transfer payments made by the pandemic are now being reduced. And maybe some of these cash buffers may have been lost in the stock market or indeed in crypto.
No, absolutely. Got that. I just want to sort of ask you this. The question is, the point is still the same, which is what would lead the Fed to slow down, take its foot off the pedal a little bit? Would it be achieving its goal of bringing inflation lower?
As I think...
B, would it be a growth slowing?
No, I think one thing could be...
stock markets.
Well, one, growth slowing and financial market damage, but another very important thing is politics, because as I said, half the reason the Fed did such a dramatic U-turn and has suddenly started talking so hawkish is because in Washington, there was suddenly pressure from the moderate part of the Democratic Party and the Biden administration for the Fed to be seen to be doing something about inflation. For the first time in about more than 40 years, we now have pressure on the American Central Bank from the executive and legislative arms of government for the Fed to tighten. This is something we have not seen for many, many years. However, the nearer we get to the midterm elections, and if markets are very weak and the economy is weakening, then that pressure from the Democrat side might go the other way. And if the pressure starts to go the other way politically on the Fed, then I think based on the track record of the Fed, the chances grow significantly that the Fed softens the language, even though they will not, very unlikely to have met their 2% inflation target. So if the Fed starts to do a U-turn when inflation is still running well above 2%, that will be basically confirmation that they're going to let inflation be structurally higher going forward. That would be dollar weak. That would be negative for the dollar, bullish for gold, and very negative for treasury bonds, but better for equities.
Chris, we've
got for equities. Yeah.
We have the May consumer price inflation numbers with us now, and core CPI has come in higher than expectations. So the unrounded number is 0.63% month on month core. The consensus was at 0.5% growth month on month, and even that was, was being acknowledged to be pretty strong. Other details are also the rents price growth is the core headline growth is 6% year on year. So it seems like a pretty strong. So this confirms continued headache for the Fed. And how would you read this in terms of Fed action?
No. Well, I think this is just this will keep the inflation story bubbling, So it will keep the pressure on the Fed to tighten. So this will, I'm sure, make the market assume the next rate hike will be 50 basis points. The interesting technical point is if they're, and I've got no idea because I haven't seen the data, but what's been coming evident in the last 2 months is that the pricing pressures have been moving from goods to services, and inflationary pressures in services are more sticky. So if that is confirmed in the report, if that's still the trend in the report out today, yeah, that will create more concern. But you see, the problem is the Fed's so far behind the curve that if the Fed really wanted to crush inflation, it needs to impose real rates today. And obviously, they're nowhere near imposing real rates. So both the Fed and the ECB are massively behind the curve. And they basically, they're in a very unfortunate situation of playing catch up. But the market, while the market's weak, we haven't had a market collapse yet.
Yeah, no, absolutely. Chris, so 50 basis points in the next meeting, next week, 50, one more 50 after that, and then, well, the debate about whether it's going to be another 50 or 25.
My advice to invest, there's no point, you just want to take one meeting at a time. Like you want to take one CPI, because there's no point speculating beyond that. Yeah. Because there's too many variables. But I would be amazed if the Fed did not raise rates by another 50 basis points at the next meeting. Meanwhile, as to the Fed governor's long-term forecasts, while they revoke a lot of discussion, we need to remember one simple fact. As recently as last September, more than half the Fed governors in the US said no rate hike at all in 2022. So, these forecasts are not really worth anything.
Chris, stay with us. We'll take a quick commercial break here and we'll turn the gaze to India and what you make of the market here, which is also in a pretty strong corrective phase. Stay with us. We're in conversation with Chris Wood of Jefferies. Chris, thanks very much for staying with us. Chris, of course, has been running us through what he makes of the global situation, and he does think that the Fed will be pretty aggressive and focused on inflation, so markets should be aware of that. There's no changing that fact, at least not for right now. Chris, let's come to India, where we've seen a sharp correction as well. In your latest Read and Fear note, you say an interesting thing. You say the risk, the fact that Indian markets have been held up because of domestic inflows, and the risk to those domestic inflows is that about 50% of those flows came from retail investors putting money directly into markets and not via funds. Could you explain that?
Well, no, this is a point highlighted by my colleagues here in India, and I think it's a very valid point. So first of all, what's the remarkable development this year is the continuing pretty dramatic level of FII foreign selling of Indian equities, which by historic standards is as much as we've ever seen. But we've also seen this remarkable staying power of the inflows. But what's interesting, last fiscal year, about half of the flows were actually people investing directly in stocks, not through funds. So clearly, as time goes on and months pass, and on a 12-month rolling basis, people are no longer making gains on their investments, there's got to be a risk, if not a probability, that the domestic flows reduce. But having said that, it's remarkable up to now how resilient the Indian market's been. It's also explained by the fact that India has a very good macro story, in my view, right now on a 10-year view. We've got a lot of positives, of which, as I discussed last time, the key one is the property market having clearly turned up. On my trip this week, we're picking up more anecdotal evidence of a capex cycle coming. But this is a year where the Indian market would do very well to trade sideways, so long as the backdrop is Fed tightening, and also we have RBI tightening. Now, the RBI tightening dynamic is nothing like as dramatically negative as the Fed one, because the RBI is nothing like as behind the curve, though it is behind the curve, so it's good news they raised 50 basis points this week. But we have the other variables of the food and oil-driven inflation, of which the most dramatic is the potential. There's two real dramatic drivers, actually. There's the oil price, which I I had a view that oil was going to 150 even before Ukraine because of the supply constraints caused by the attack by the political green lobby on fossil fuels. But clearly Ukraine has added a whole new dynamic in terms of fertilizers, effect on food prices, etc. So all this is a negative headwind, and the base case has to be that the Indian market corrects further. However, in my view, a big move up in oil, while it will be very negative in the short term, is not going to kill the Indian economy like it would have done historically. And as I said, my base case is that the Fed language changes before year end. I'm not expecting the Fed to be still tightening like this time next year. And therefore, it's just a question of watching out for that change in Fed language. If I had to guess at the timing of that change in Fed language, and it's purely a guess, it would be late third quarter.
Chris, if the S&P were to fall, as you said, at least 30%, say it falls 30%, what happens to the market here in India? I mean, you know, the Nifty earnings for FY24 are estimated to be about 1,000 rupees. Let's say there is a 10% earnings cut based on all that is happening, right? So earnings estimates drop by 10%. Based on where the index is right now, that puts us at about 17.5, 18 times 1 year forward earnings. What is your sense in terms of where valuations and the index bottoms?
Well, Mike, in a world where the Fed keeps tightening and we have more of a, in my base case, we go down 30% or more, you know, to me, the sort of level on the Nifty is 1,400, 14,500.
14,000, 14,500.
Yeah.
Okay, got that. Chris?
Now I'm just saying on a chart, that's on a chart where you look to have support. But it doesn't have to be that. I mean, it doesn't have to be that bad. It could be, if the domestic flows hold up, then there's a potential possible outcome where the Indian market just trades sideways. It's not my base case, but that the Indian market trades sideways, and you know and the valuations are adjusted by the course of time.
Got it. Chris, you have cut your...
I mean, the 2 points to make is the inflation. The inflation issue is much greater in America than India, one. And two, US equity market, well, India is an expensive market, but US equity market valuations are way more expensive, in my view, than India, most particularly if you look at valuations relative to sales.
Got it. Got it. Could you talk about what your are you changing your portfolio up here in India, the model portfolio up a little bit? For example, you've taken off some weight from HDFC Limited. You've added that into HDFC Bank. You know, a couple of other changes.
I've just adjusted it from them. I've just adjusted. Nothing dramatic. Maybe later, but no, I'm perfectly comfortable with the long-term structural story in India. The risk, frankly, is just that the monetary tightening cycle, the higher rates delays the broader capex pickup. But all the evidence is the property recovery is underway, and India is a domestic demand-driven story, so that's good news. But history suggests that India stock market is highly influenced by moves on Wall Street.
Absolutely. Absolutely.
Given the foreigners have sold, given the foreigners have sold so heavily, the foreigners will be looking to buy on any significant correction in India.
That's interesting. That's interesting. You know, I think you had also suggested that
that level I identified. That level I identified on the Nifty, in my view, if you ever reach that level, would trigger a lot of foreign buying.
All right. Those levels that you were talking about, 14,500. Okay, got that.
Yeah.
You know, since you brought up the foreign selling point, right? There's been a fair bit of talk about what's going on, and I think we've discussed this before, that when people want to sell emerging markets, China being the big weight, it kind of drags down flows into other markets like India as well. And I think, I'm not sure, but did you highlight the fact that maybe it's time to look at emerging markets ex-China? I mean, would that happen? Would that come to fruition?
No, I'm not. I'm not recommending it. I'm saying that is that is not my opinion. That's just an observation that this dialogue amongst amongst the clients of investment managers, such as pension funds and endowments globally, there's a growing discussion of whether it's appropriate to have emerging market mandates ex-China. Originally, this discussion was driven by the view that China is such a big market, it merits a separate allocation on its own, and the rest of the emerging markets should be treated separately. But in the recent past, this discussion has taken another form, because many people are arguing that China is uninvestable, or that the Chinese government no longer likes the private sector. And there are people in the US who are arguing that people should not be investing in global emerging market mandates, including China, because China is perceived as the enemy. So this is a discussion underway. But the simple point is, if you have a global emerging market mandate excluding China, then the other markets become much, statistically more significant in the benchmark, of which India would be one obvious beneficiary.
This may be a bit of a sweeping statement. You already said you're pretty bullish on some of the structural themes here. But manufacturing versus services, given all the commodity cost inflation that we are seeing, many are saying that maybe it's better to be on the services side rather than manufacturing over the next 12, 18 months. Would you agree?
Well, it depends. If the costs of all those higher input costs finally end up being passed on to the consumer, then I'm not sure that's the case. It really depends if they're able to pass the costs on, doesn't it?
No, it does. It does. Chris,
so I think that's something we need to watch.
Yes, yes. And I think that's the reason why there is so much debate about who is pricing power in this environment and of course, the like.
Yeah.
Chris, it's a pleasure. Thank you very much for being here on this special show. It's always a pleasure hosting you here on CNBC-TV18. Thank you very much for joining us. Well, that's Christopher Wood at Jefferies with a global equity strategy perspective and, of course, a focused view on India as well. Thank you very much for staying with us. More coming up in just a bit.